And Laura, you see growth and inflation both higher this year, but of course rising inflation is stoking rising costs for a lot of companies as well. So in terms of a high growth, high inflation environment, what's the path of least resistance for equities?
Well, first of all, you have to focus on valuations, because against that kind of a backdrop, we're likely to have rising interest rates. We've already had the Fed signal that they're likely to move in March, and that is going to take a little bit of the sting out of the higher growth equities. So we have been looking at places like, as you mentioned, Europe and Japan, where we think that valuations are much more attractive. We've got sentiment, and the complexion and makeup of those sectors within those geographies is much more cyclically geared towards that growth story.
So you like the valuations of Japanese equities, but how does the earnings picture look to you in Japan, especially when, as I say, input costs are rising?
They are, and I think one of the things that's been interesting as we've gotten through the first quarter's, or really the fourth quarter's earnings season over the last several weeks, is that companies that have been able to manage that cost structure, either by passing along costs to consumers because they have dominant brands and they can maintain that pricing power, or through managing their bottom line through technology investment and doing other things that just enhance their productivity, those are companies that are able to drive to the bottom line. So we find a lot of high quality companies that are relatively attractively valued. And as I mentioned, there is a bit of a sentiment move there too, as you have more money flowing into those markets.
Are you looking at specifically Japanese stocks, or are there other regions across Asia that you see value as well?
There are other regions. We like the Asia region writ large, although there are some weak spots. We're actually favoring Japan over Australia, for example, right now. But we also like the long-term China story. And again, there are lots of things to be worried about there in terms of the short term, and just the focus on the zero tolerance around COVID and what that means in terms of economic activity. But we do think that China is poised for long-term growth. We see, the pullback in China as being an attractive entry point. So it's not just a Japan story.
And what about the semiconductor high-tech story across Northeast Asia? Because, of course, we have seen this massive upside when it comes to either Taiwanese stocks or South Korean stocks as well.
Yeah, we certainly have. And we think that's going to continue for a bit longer because, as you know, it's not like you can just wave a magic wand and get a lot of supply, and there's going to be continued demand. So that is an area where we think we're cautiously optimistic, but we do think, and that we think there's more to run, but we do think that it's going to get, at some point, that will play out. And so we're diversifying our bets a bit beyond that sector.
Laura, you do still see the Fed as the biggest exogenous risk in 2022 rather than the COVID pandemic. How has the Fed been managing its communications so far? And I'm particularly curious about your thoughts on the plans around running off that enormous balance sheet.
Yeah, so one of the things that's been very interesting about the Fed is we actually think that the Fed's been quite consistent in saying that it was time to lift off, right? It's time to shrink the balance sheet, at least, stop the asset purchases and ultimately start to unwind some of those asset purchases and to raise rates. And yet somehow the market continues to be surprised, right? And it was notable to see how markets were pricing, 3, maybe 4 hikes, and then after the Powell testimony last week, you had some prognosticators say there might be 7 interest rate hikes. We're in the camp that we think that Powell is actually going to be data-driven and that he's going to maintain flexibility. And it's unlikely that they're going to have to be as aggressive in tightening as what some prognosticators think, in part because we think we're going to see a lot of weakness in the second half in the U.S. So we really do think that the Fed is going to raise rates. They're going to do so probably in a couple of measured increases over the next several months, start to do asset runoff probably second half of the year. But it's unlikely that they're going to be able to move nearly as aggressively as some markets are pricing in.